Now, the NSE All-Share Index is down for the fourth consecutive session, largely due to losses recorded in the banking sector in response to news by Nigeria's Central Bank's Monetary Policy Committee to introduce a 50% reserve requirement on public sector deposits. The NSE shed about 0.9% to close at 37,554 points. Some of the losers on the day included Zenith Bank, FBN Holding, CCNN, Guarantee Trust Bank, while gainers included Nigerian Breweries, Forte Oil, Corn Oil, MRS, and Champion Breweries. Joining me now from the stock exchange to talk us through the market's reaction, Babajide Solanke. He's a research analyst at FSDH Merchant Bank. Babajide, thank you for joining us. And I think it was expected. A lot of people were calling this, that the market will fall back today. We did see the pressure, particularly in the banking sector. Can you just talk us through your thoughts about how significant the fall was today? And many people could suggest that this is a mild reaction given the implications of the Monetary Policy Committee's decision to introduce a 50% cash reserve ratio on public sector deposits.
Thank you, Wally, for having me. Good afternoon. As you rightly said, the market received the news of the 50% increase in cash reserve ratio for federal, state, and local government and the MDAs, ministry departments and agencies of government. Well, with what you've seen, with sadness, in terms of performance of most banking stocks, almost all the banking stocks did lose today, because there's a general fear, immediate general fear of how bank earnings will be impacted by this massive increase, a massive introduction of a new policy stance concerning government, all tiers of governments. Wow.
Well, I think a lot of people were hoping that the second half will find a catalyst, but clearly this is not a catalyst. But how bad do you think this is going to get? What do you think this means for the equity market in the second half of 2013? Unfortunately, it seems we have lost that line to the Nigerian Stock Exchange. We'll try and get it back in a little bit. But of course, I was trying to get his sense of where the market is likely to go after this decision. Of course, the market is up well over 30% year to date. But the big question is, what next? A lot of people are hoping that we might see a moderation in yields in the fixed income market. It seems that is very unlikely now. And of course, the banks would be hit by this move by the Monetary Policy Committee to introduce a 50% cash reserve requirement on public sector deposits. What that means for the market, we'll find out as the weeks go on. Now let's move on to, well, I think we do have Jide back on the line now. So Jide, can you just talk us through your thoughts about how bad the fall could be as we move progressively into the second half of the year? This is certainly not the catalyst a lot of people are hoping for. What do you think this means for the market longer term?
Longer term, as you've rightly said, well, there's trouble for the remaining half of the year, because what has happened is that most people believe that banking stocks will help to galvanize interest in the market, continue to attract investors' interest. They've got a low PE valuation, but given this current monetary policy stance of the central bank, there's going to be enormous serious pressure on bank earnings for the remainder of the year. But however, this will be mitigated by the fact that most of these banks have locked into government fixed income, government treasuries, and government bonds for the next 1 year. So, well, there will be a hit in the medium to long term, but in the immediate term, bank earnings are kind of secured, given that they've locked in.
All right, so there will clearly be some earnings pressure in the sector, but does that justify the sell-off we're seeing? Because, like you rightly said, very low PEs in the banking sector. Do you think that this is an overreaction?
Yeah, it's an overreaction, clearly, Wale, because the market is based on news. Current information coming to the market affects a lot of people's mood. It's psychological. People just react on bandwagon effect. But as we rightly said, it's an overreaction. I believe that banks, as we rightly said, as we've always held, that they need to expand their risk assets. But anyway, everybody felt, okay, maybe they won't do that because the government monetary policy going forward and yields in the fixed income security going forward looks good for them to be able to invest in. But going forward, I believe the banks will still make earnings. The Nigerian economy has strong macroeconomic fundamentals, and going forward, there's robustness of the economy, and going forward, I believe banks' earnings is protected. All right,
so you're calling this an overreaction. In that context, which stocks look good for you right now? What should we be buying into this dip?
The banking stocks are still a good buy. Depending on how long you want to wait for it to be able to get at the cheaper prices. GT Bank is a good one for me. Access Bank is a good one. First Bank is a good one for me. I like Flammers. I like NACO as well.
All right, but okay, you just touched some non-bank stocks. I wanted to get your thoughts on what this means for the non-banking sector, because one could argue that higher yields, we are seeing that already, and we'll get to that later on the show. We are seeing a pickup in yields even in the fixed income market. One anticipates that this could translate to higher lending rates. I wonder if that's your view as well. So if that were to happen, this is something that would also impact the non-banking stocks. So what do you think this means for non-bank stocks?
Yeah, for non-banking, so what has clearly happened is that it's a kind of a boost, it's a kind of a plus for a positive for non-banking stocks. What it means generally is that banks need to look beyond government securities. They need to begin to look for the traditional means of ways of earning income, which is by expanding the balance sheet, expanding the risk assets. Well, you can always argue back and forth, but the truth of the matter is that high interest rate has always been with Nigeria, has always been in the Nigerian system for as long as you can look back. So basically, well, you can't say that there will be an increase in interest rate for the non-banking stocks, but generally, what it just means is, in conclusion, is that banks need to expand the balance sheet, and if they're going to expand the balance sheet, well, not oil and gas sector, given all the threats to earnings from that particular sector.
Right, of course,
but
the results we just saw from Skybank do not reflect the impact of this decision. Clearly, it's going to show in the next quarter, numbers. But your thoughts about what we're seeing from Skybank? I think some people were disappointed. It's pretty modest growth in earnings there.
Yeah, it's disappointing, but it's too quick to call, because we still need to engage the management to actually ask what happened and why that teen growth. But anyway, as I said, we still need to engage with the management to be able to actually know what happened with that particular earnings and trickle down to the.
But is this something that you are looking to buy? I think I've been reading a bit about some thoughts. Some people think that the value is still a valuation play, regardless of this MPC decision. Is Skybank something that you're willing to add to your portfolio?
Yeah, I'm willing to add it to my portfolio. Like most banking stocks, I'm willing to add them to my portfolio.
All right. What about outside the banks? We saw Transcorp also release numbers today. Is that a stock you like as well?
Well, I won't touch Transcorp. But a quick look at their books today. I went into the cash flow statement, and I saw that the significant income was made from fixed income investment. Well, that's just what happens with the current monetary policy stand. Everybody just kind of making money. I don't see that they're not making much money from their normal activities, their normal operating activities, and I'm worried about that going forward.